If gold is such a worthless metal, why does the United States government and all the governments of major nations hold so much of it? The dollar should be a stable currency. It should provide a dependable store of value. It should be a meaningful unit of account. And I like the fact that the US dollar is already the medium of exchange that is the dominant currency in the world. I just think we could make it better. It's just a scam. And to make it real simple, I would put it this way. A dollar today in 50 years at 2% inflation will be worth 37 cents. At 3%, it'll be worth 23 cents. I say, why can't we have a dollar as good as gold? It used to be. The expression sound as a dollar came from the time when the dollar was convertible into gold.
Dr. Shelton, welcome to the InFi podcast.
My pleasure to be here. Thanks for asking me, Bob.
Well, we're here to discuss your forthcoming book, which is available for pre-order from the Independent Institute, called Good as Gold, How to Unleash the Power of Sound Money. And so I guess the first thing out of the gate that I'd like to touch on, I was looking through, it looks like it's a very good book, is in the beginning, you talk about back in February 2020, when you were being nominated to be on the board of governors for the Federal Reserve System. Can you share your thoughts on what kind of experience that was?
Well, it was pretty intense. I have to admit, I was so honored to be nominated to serve on the board of governors of the Federal Reserve. I thought a pretty good academic reputation in monetary economics. I'd written a couple of books. I'd been a postdoctoral fellow at the Hoover Institution, and then they made me a member of the scholarly staff there. I had an office down the hall for Milton Friedman. So I felt pretty good about the work I had done, and I thought this would be great to apply that as a member of the Federal Reserve Board. But I found the immediate press attention was sort of staggeringly negative. And I think that threw me. I'm kind of a fighter by nature, but it came down to that hearing, and it was really aligned. I don't think I expected it to be so brutal. I think that's the word CNN used, or CNBC, and said it was a rough hearing. I felt strangely happy afterward, maybe because I had a chance. One of the senators had said, instead of being led into a question, why don't you just say something you want to say about all this? And I said, I believe that sound money is a moral obligation of the government. And that's where I start from the constitutional nature of having a standard of value that is trustworthy. So bottom line, I would say the overall experience was positive. I learned that it can get quite political. I later wondered what they thought I would have done. People thought I was either a hawk or a dove or vacillated. I always felt like I'm really neither. I'm a woodpecker. I just keep hammering away at this idea that the dollar should be a stable currency. It should provide a dependable store of value. It should be a meaningful unit of account. And I like the fact that the US dollar is already the medium of exchange that is the dominant currency in the world. I just think we could make it better. And the title, Good as Gold, goes back to saying, why don't we look at historical monetary systems that have been successful and see if that can't point us in the right direction, because it gives us the context for evaluating what we have. I think it's very useful to look at those systems and see if we can kind of go back to the future with some kind of gold link for our currency.
Yeah, I have to say, Judy, I was surprised as well. I mean, I knew of your work, and but you weren't like a bomb thrower or something, like even rhetorically, of course. And so, yeah, I was somewhat taken aback to people calling you a right-wing crank and stuff like that. Was it just because you were talking about gold so much, and like for a lot of, I guess, Keynesians, that's kryptonite?
I think so. Some of it was probably that I was nominated by President Trump.
Okay.
As I say, I was grateful for that and proud of it, but I found that seemed to set people off, I guess, from a political point of view. So pundits, I understood. I didn't understand economists unless I made allowance for political preferences. But it's funny that there was one article that came out in the Washington Post by a columnist. I have to say, I didn't have a lot of respect for their knowledge through monetary theory or history. But I was described as someone who used the words sound money as a dog whistle to the right-wing crank fringe. As I really talked favorably about the days of the gold standard. And I ended up emailing that column to Alan Greenspan. I've been friends with for over 30 years. He liked my first book on the coming Soviet crash, and he had contacted me, I think in 1990. He had just come back from the Soviet Union. And he said, if you're in Washington, I was out at Hoover Institution at Stanford in those days. He said, let's talk about that. So it started really a nice collegial friendship. I probably met with him 3 or 4 times a year throughout the time he was the chairman of the Federal Reserve. And then afterward, when he was in private consulting, met with him a couple of times after I was nominated as well. But anyway, that morning I sent that to him, and my email message started out, Dear Alan, there seems to be a historical antagonism against the gold standard, because that, I have a feeling you recognize it. That was a sentence of the article he wrote when he was an acolyte of Ayn Rand. It was in 1966. It ended up in her compendium, Capitalism, the Unknown Ideal. But it was called Gold and Economic Freedom. And that's the first sentence. There seems to be a historical antagonism against people who favor a gold standard. And he attributed that to the notion that such people were really trying to confiscate wealth from the private sector, that they were welfare statists, he called them, meaning they would rather redistribute income than make it possible to have a stable monetary platform that protected people from confiscation by government of their property, that enforced rule of law. And he said a gold standard was the only thing that guaranteed that sort of economic liberty. Well, he wrote back, said within an hour or so, he said, that's a very interesting column. And he said, if gold is such a worthless metal, why does the United States government and all the governments of major nations hold so much of it? And it kind of insulated me from the punditry and from people who would say this was right-wing fringe. I've also had a great relationship with Paul Volcker. I would see him every year at an international monetary conference hosted by Robert Mundell. I co-chaired that conference with Mundell in his last few years before he died. He won the Nobel in 1999 for his work on gold and monetary systems historically. And of course, he was the intellectual godfather for the euro. So he knows something about currencies. And Volcker I had met and did a 3-hour televised interview in 1994, the 50th anniversary of the Bretton Woods system. And Volcker would regularly and easily, along with Greenspan and of course Mundell, talk about the influence of gold in monetary systems. So I thought even Milton Friedman, who was also a senior research fellow, as I was at the Hoover Institution, he was very much against the Bretton Woods system. He did not trust governments to live up to their obligations. And sadly, I think he was proven right when the U.S. reneged on the gold convertibility guarantee. But he, especially in his later years, he had debates with Robert Mundell, but he ended up saying that he would prefer a unified monetary system, a gold standard would qualify for that, he said, as being consistent with the principles of free trade, and he would prefer it over a dirty float, which is what floating rates had become, where we have governments intervening. And I know for sure Milton would have hated how our lack of a system today has empowered central banks, because he thought that was very unhealthy. He much preferred a rule-based approach. So bottom line, I think instead of it being fringe, it really should be mainstream among the intellectuals and the people in the arena, the policymakers who truly understand.
So yeah, I definitely want to unpack a lot of those different threads there in the course of this discussion, Judy, but can we, just for the benefit, and so Judy, like our audience, I think is very free market friendly. I think this is mostly a financial community that watches this particular channel. But I just know when I talk about gold and the history, there's a lot of, people have been taught that, the U.S. used to be on a gold standard and it caused the Great Depression. And you really want, the Fed's hands are tied. They need to be able to intervene to help the economy when it's stuck. And why would the gold standard is this barbarous relic and so forth. So can you maybe what's wrong with that standard junior high view that I think a lot of Americans have been taught?
Well, if the rationale for the Federal Reserve or for any central bank, but let's take the world's most important central bank for our own country, if the rationale is that this is how we will avoid financial crashes, then how do we reconcile that with what happened in 2008? Because I think you could certainly argue that there was no institution more likely to be responsible for an overexpansion of money and credit than the Federal Reserve. And yet they didn't see it coming. They couldn't prevent it. And all the measures they took to intervene afterwards, I don't think quantitative easing proved to be helpful. It was only when interest rates finally started going up again. I mean, that period between 2008 and December 2015, when they finally went up a quarter from zero, was wasted. It was a terrible time economically. So I think monetary stimulus is really overrated. And I think quantitative easing, purchasing government assets, we saw the portfolio of the Federal Reserve go from virtually nothing to these massive amounts, trillions. And then, I mean, just after March 2020, after COVID, they added another $4.5 trillion. So you had the Fed enabling this vast expansion of money, which resulted in inflation. And so I guess I would say, compared to what? When people say, oh, the gold standard's outdated, we need government intervention. I remember when Greenspan gave a speech as Fed chair talking about the gold standard, and he said, we will always have irrational exuberance. That's the nature of capitalism. That's human nature. It's very basic. But he said, when the world was on a gold standard, those periods, those episodes tended to be limited in scope and in depth, in the time that they impacted economic performance and the damage they inflicted. And I think he made a good point. I think a gold standard really is kind of an organic way of letting the individuals in an economy, the ones who participate and comprise the economy, trust their own instincts. If they think things are getting frothy, they have the option to convert, at least in the old days, out of the currency into gold. And so it was self-correcting in the sense that that is how the money supply was regulated. Does it seem more rational to have 12 voting members made in Washington 8 times a year, looking at data that we're seeing that can be questionable, and deciding what should be the cost of capital? I would say that there's no more important price in a capitalist free market economy than the cost of loanable capital. And yet, even after seeing what happened to the Soviet Union, and I was very much involved in analyzing their internal monetary and credit situation, even after realizing that central planning doesn't work, that's how we regulate the money supply. And it's even gotten worse. The Fed's fundamental tool is no longer open market operations. It's not like in Volcker's day when the Fed would buy and sell a few government securities to try to raise or lower interest rates. And it was the interest rate was just the rate at which banks borrowed from each other. Now banks are so overloaded with reserves, that market is gone. What the Fed does instead is by diktat say, here's how much we will pay commercial banks on their cash deposit that they must hold at the Fed. And they have over $3 trillion in there. We will determine what rate we will pay to keep that cash sitting stagnant, to not let it go into the economy, to not lend it to the private sector. And that is how we will keep the money supply limited. To me, that is like paying farmers not to grow crops, like paying people not to work through government fiscal transfers. It's really an affront to free market capitalism. And I think the idea that there's a connection between effort and reward.
Yeah, just to elaborate on that, Judy, it was, I know you know this, I'm just saying for the purpose of the audience. So yeah, the Fed started paying interest on reserves in the fall of 2008, right after they pushed, like the first vote failed and they pushed through TARP, on the follow-up, they hit a mulligan. And so I was going around, I was being a bit cheeky, but I was telling crowds that, yeah, you know how they just pushed that through? Because they said, yeah, it really pains us, but we got to bail out Wall Street to rescue Main Street. The Fed also began paying banks to not make loans to their customers.
You're
so I mean,
100% right. The night of the first time the vote failed, we just referred to, I was in Paris. I got a call about 8 at night from the editorial page of the Wall Street Journal. And they said, could you write something for tomorrow's paper? And I did. And it started out with, this is the way the world ends. This is the way the world ends. But I said, the problem is the money itself. The problem is the money itself. Well, everyone will be finding fault, but we have set ourselves up for this kind of financial reckoning. And you're right, on the next vote, they included the right to pay interest on reserves to banks. They moved it up from when they thought they might do it in the future. They moved it up, and that became part of the emergency bailout package. And the banks then almost immediately with Q1, Q2, QE3 started gaining reserves. But I think it was registering with them that at some point they could get paid for just doing nothing with that money. It's hard work to be a financial intermediary. My husband was a banker. And you really have to judge people's confidence and their plans and their character and the chances that they'll repay, that they're good for it. And you have to monitor it. And you have to be a partner with them. I think the Fed began at that point training banks. They didn't have to do all that. And in fact, the Fed liked them to have ample reserve, which meant less regulatory pressure because we know we were starting to get all of the new regulations in the wake of 2008. So they were getting leery of that. But when Janet Yellen in December 2015 started raising, and then just a little bit, and then the following year, a month after Donald Trump had won the presidential election, they raised again. And then in 2017, after he was inaugurated, they raised 3 more times. And then Jerome Powell was brought in 2018, and he raised 4 more times. So you had 9 consecutive increases in the interest rate. And that meant that the banks who had all those reserves were getting paid to leave the money sitting there.
And just to go back to something you said a few moments ago, that most economists are generally agreeing that top-down central planning doesn't work. You can't literally have a bunch of political officials picking the price of steel and wheat and so on. And yet everybody in our system seems to take it for granted that, oh yeah, a group of people get together and then announce what our interest rate, or at least one very important interest rate, going to be for the next few months. And nobody seems to think that's weird.
I guess that's the part that is still amazing to me, that if you describe our system, how does it work? It sounds so illogical. And it seems, I would think it would be far more objectionable to the average citizen, because the average citizen probably can't listen to Fox Business News or CNBC all day long. And they can't be there to hear the press conference after every FOMC decision. And they're not sufficiently schooled to dissect the nuance of a slight change in wording from a Fed statement. It just seems to me that there's a form of monetary favoritism that rewards some people to the detriment of others. That money doesn't work the same way for everybody. But if you're part of that cottage industry that obsesses over what the Fed will do next, and the Fed seems to encourage that, they have such a massive footprint in financial markets, that huge portfolio, and they seem to encourage this speculation over what they will do next. And they're very careful how they're communicating. And yet you have conflicting voices that in the end never have a dissent against a consensus opinion. And then we're left to go through transcripts and nets and try to figure it all out. One thing about the founding fathers, they assigned Thomas Jefferson to write up his notes on the establishment of a money unit. and consistent with the idea in the Constitution that U.S. money would be set up by Congress in the same way Congress would establish our official weights and measures, caused Jefferson to say we must define our money unit, and then we must say with specificity what a dollar is. And this 12-page set of notes he wrote up on the establishment of a money unit for the United States said that it should be simple. First thing was our money should be simple, easy to use. It's meant to be a tool. It's meant to be a tool to measure value. Our country is going to be based on economic liberty. And so we want to facilitate commerce. He said, why don't we abandon these systems that use shillings and pence and farthings? And he said, let's have something that's easy to use for addition, subtraction, multiplication, and division. He said, let's have a decimal system, money system. And that's what we have. That's what he recommended, and that's what we accepted. He said it should be money that people are familiar with. It shouldn't feel exotic. I think the Fed makes monetary economics not just exotic, but boring for people.
Right.
And finally, he just said it should be a trusted unit of account and store of value. He was very big that it would function as it was meant to serve the people. The same man who thought that government should serve the people and not the other way around. But I think instead of being a tool for economic liberty that honors individual rights, we have money farmed out to a government agency, and they have come up with the notion that debasing the monetary unit as a deliberate part of their mandate, which says stable prices, it doesn't say stable inflation. They are deliberately eroding the unit of account and patting themselves on the back if they were to achieve their target, which they have yet to do. And I just think that we've turned money itself into yet another economic tool for the government to use in pursuing its own objectives.
So great stuff there, Judy. Just to maybe repeat some of that or paraphrase some of that, just get your feedback and make sure I'm tracking with you. So where you're coming from is to say, look, originally the vision, the sense in which Congress was going to define the monetary unit, to regulate the value thereof, was not what a lot of modern people think in terms of the Fed tweaking the purchasing power of the dollar or the rate at which CPI increases, but it was more like for commerce to work, everyone's got to agree on what a foot means or what a pound is, the meaning of weight, not British pound. And likewise, what's the dollar? What is the definition? And so you wouldn't say, oh, let's redefine a dollar to be 11 inches and therefore we can increase the production of lumber measured in feet. And that's how we're going to boost productivity. That would be insane. Like, no, for this to make any sense, if it's a unit of account, the way it helps humans and the economy is by being an objective standard that we can all agree on. And you're not changing the length of the unit to try to get a temporary illusory gain in productivity or something. Is that part of what you mean?
I think that's a very astute way to frame it. I think of the Olympics that just took place in Paris. Here you have participants coming from every country, from all over the world. And whether they're swimming 100 meters or cycling or jumping, they keep the same standard. Everyone is using the same standard. Can you imagine if the length of a meter varied depending on which country the participant came from? Just as you said, maybe the length of a meter is like so for one country. I'm trying to stay in your view, and like so for another. So you could say, oh, well, my athlete won because we counted the distance he swam using this unit of measure. No, the whole idea, it's very forward-looking. It's really classical democracy, and it really honors people across borders. It was the environment we had when Adam Smith wrote The Wealth of Nations and talked about comparative value and advantage. And that came out the same year, 1776, as the Declaration of Independence. So we had this like-minded approach that if you have level international monetary playing field, if everyone is essentially using the same benchmark, if everyone's currency however denominated, is ultimately based on convertibility at a fixed rate into the same asset, which was gold, then everyone's using the same yardstick. Everyone is using the same standard. I think that's the only appropriate foundation for carrying out the kind of international trade and investment that really does benefit humanity, that leads to more prosperous economic outcomes because it encourages long-term investment. It supports the virtue of sacrificing consumption today to have the seed corn, to have the funds that become the capital investment that allows the entrepreneurial energies of free individuals and businesses to develop new technologies, to spend the time in research and development. And you end up getting those kind of innovative breakthroughs that really do raise the standard of living for everyone and make goods and services accessible. So that's the kind of prosperity that I welcome. It's profoundly liberal in that old Jeffersonian context.
Right.
You know so well and speak of so beautifully. It's profoundly moral. And I think is to the benefit of the prospects for peace and prosperity. So that's the kind of system I support. And I find a government managed approach that says, you will take the inflation as it comes. It doesn't matter to me that Chair Powell so often says price stability is the responsibility of the Federal Reserve. Who got fired for 9% inflation? Who got fired?
Well, yeah. And as you
accountability is that?
Right. And as you have alluded to, Judy, and I see it in your book as well, like there's people have been using the term gaslighting a lot lately, and so I don't want to overuse it, but they've redefined now price stability is defined as the dollar loses 2% of its purchasing power for consumers year in and year out. And that's literally what they mean by price stability. And it's like, no, that's not stable.
And we're supposed to be okay with the government skimming because it benefits debtors. So the government's the biggest debtor. But when you think of it, it's really expropriation. It violates rule of law. It's confiscation of wealth. It's purchasing power. Let's say you earned your dollars and you don't want to invest them. You don't like risk. You literally put them under your mattress. You might use them 10 years later and they've lost at least 20% of their value. It's like a tax suddenly hit you the day you wanted to use that. Your purchasing power was diminished deliberately to the Federal Reserve's monetary policy. I think of people who maybe, let's say today, somebody wants to buy a house for $600,000. And let's say the Fed hits their target for the next 10 years. Well, you add the 12,000 price increase that strictly reflects the inflation for 10 years, and maybe they sell that house. They haven't made 1 cent of real profit, but the price of that same house is now $720,000. They have to pay taxes on the $120,000 capital gain. It's just a scam. And I don't see why people should have to constantly worry about whether the COLA clause is going to compensate them adequately. Do they have to get cost of living or a CPI adjustment from their employer all the time, trying to keep up? I think it's very condescending for economists to think that people don't realize it. And yet the rationale for that 2% price target can be traced back to an FOMC meeting at the Federal Reserve that took place in July 1996. And Greenspan was chairman. And he said the topic of the day is, how do we interpret our mandate for stable prices? And he ventured out. He said, maybe that means zero inflation. I would tend to think that's the logical answer. But he asked around the table. Janet Yellen was a member of the Board of Governors. She was using work done by her husband, very eminent economist. And he was of the Keynesian persuasion, and he believed in money illusion. It's now called the greasing the wheels theory. But he said, well, it's better to have a little inflation because then let's say you're in a situation with a slight economic downturn. Let's say a company needs to cut wages 1%. It would be better if you had 2% general price inflation, because then you could give your people a 1% nominal raise, and yet you're cutting their real wages 1%. But they never notice And I think it's a mistake to believe that people don't notice. In telling that story, Yellen said she had a survey that was conducted among workers.
Mhm.
And the workers said, would I be happy if I got a 1% raise, even if inflation was also 1%? And just over half the workers said yes. And that was given as evidence that, see, they don't know the difference. And then she said, and it's in the transcript, you'll be happy to know, you at the table,
Mhm.
that when given that same survey to a set of economists, they said they wouldn't be happy. And then it shows in the transcript parenthetically, laughter. I thought, well, see, that's the problem.
Mhm.
And I think it's that hubris, that arrogance of thinking for the Fed's theory and also for its convenience, the Fed would like to have more policy space. So if they can move up their target interest rate by another 2% or more, then it gives them more room to drop it in the event of a contraction that they're trying to react with monetary stimulus. But again, I would say, I don't think that stimulus is working out so well. I think it ends up bringing about malinvestment. And I would venture to say, if you really checked out economic performance and looked at the after effects of artificially low rates, you could see that it did more harm than good.
Right. Yeah. I think the Fed's track record, and I'm sure you're familiar with this, Judy, that there's been like Larry White, and he had some co-authors, I think George Seld, just looking at the Fed's track record on its 100th anniversary and just using, standard econometric techniques and just by any metric, the Fed had more, economic instability, like macroeconomic instability after it was founded. Even if you took the Great Depression out and just kind of gave them as like, well, they were learning, they were just getting the training wheels on. Still, it was, not obvious that the Fed was promoting macro stability. And of course, the strength of the dollar was clearly worse, from under the Fed than in a prior period. Okay, well, just looking at the clock here, I want to make sure we cover, Judy. So I'm sure people are like, yep, they understand your commentary. They might agree with you, what you're saying, your diagnosis of why the current system is bad. And, you've alluded to it with different governments debasing their currencies to get a advantage in terms of exports and whatnot. But so what do we do? Like, you've studied history, you've seen what's worked in the past, what didn't. Right now, if somebody's asking you for advice, is okay, what do we do with the current global monetary system? What thoughts do you have and how to make it better?
Well, I appreciate your asking, because that is the hard part. The book, Good as Gold, is actually divided into two parts. Part one says, can we reach consensus? Part two says, can we take action?
Mm-hmm.
And the consensus is that central planning doesn't work. Can we agree on that? A stable monetary platform is the best foundation for productive economic growth. Can we agree on that? And should money work across borders and through time? I think we should be able to agree on that. That's more of a futuristic concept, but it's one that worked very well under both the classical international gold standard and under the Bretton Woods international monetary system, which were both included convertibility of the dollar into gold. And I think that was the anchor that was behind the success of both of those monetary systems. So I start with that, and then I try to propose a real initiative that we could do. And I'll say at the outset, it doesn't have to be gold that would anchor an international monetary system and I think deliver much better domestic monetary policy. Then I think, why not gold? It's already in the portfolios of major central banks, alluding back to Greenspan's observation. But there's something else very interesting. Ronald Reagan, as president, had hoped to reestablish some kind of link between the dollar and gold. He said, until we do that, we'll never get through this inflation. We'll always have that risk. Greenspan spoke favorably about a link to gold even a year after he left the Fed. He left in January 2006. In October 2007, he said, there are some of us, myself included, he said this on Fox Business to David Asman, who believe we did very well under the gold standard. When he said myself included, he meant himself, Alan Greenspan, former chair of the world's most powerful central bank. My idea looks at the fact that the United States is the world's largest holder of gold as official reserves. We have 261 million ounces. We carry them at a value of $11 billion because that was the rate at the end of the Bretton Woods system. Nixon closed the gold window in August 71. By the Smithsonian Agreement in 73, it was truly over. And having no system was the new system. We've been carrying that gold for what? Over 50 years. At the current price, it's worth, I used to say over $500 billion. It's over $650 billion. That's not nothing.
Mm-hmm.
My idea is we could leave it for another 50 years gathering dust. I certainly don't want to spend it and then use that money on more wasteful government spending. I don't want to do that. What I'd really rather do is lock it up. Lock it up as collateral, but use it to launch a Treasury-issued long-term debt instrument. It could even be a 50-year bond. And I say that because in 2026, we'll have a new president. In 2026, if we are celebrating our 250th anniversary of the Declaration of Independence, I think it would be very interesting if a president said we're launching a 50-year long-term bond that will mature on July 4th, 2076, our 300th anniversary. First, it's kind of sobering that some of us might say, oh, can we count on that? Well, let's assume we want to count on that. But how many times have we heard officials at Treasury or Jerome Powell himself say our fiscal path is unsustainable? Everyone says that. But when are we going to start setting up a marker? When do we establish a beachhead to say we're going to try to change that? So let's say Treasury issues now. It'll be the first time in 50 years, any kind of link between the US dollar and gold, a gold convertible bond. And to make it real simple, I would put it this way. If I were to say to you today, would you rather have 2,500 US dollars or an ounce of gold? You might say, I'm indifferent because that's the cost. That's what I would pay for it. That's what I could sell it for. Fine. If I were to say, here's an instrument that will give you the right in 50 years to have either $2,500 or an ounce of gold, what would you rather have? It's almost laughable. Of course, the gold will still be an ounce of gold, but the dollars, we know it'll take many, many more dollars. How many? Well, $1 today in 50 years at 2% inflation will be worth 37 cents. At 3%, it'll be worth 23 cents. But the ounce of gold will still be an ounce of gold. When I talk about looking at prior monetary systems and examining their virtues and trying to reform our status quo monetary arrangements into something better that captured those features, I say, why can't we have a dollar as good as gold? It used to be. The expression sound as a dollar came from the time when the dollar was convertible into gold. I'm not saying the entire monetary system, we couldn't begin to cover outstanding Federal Reserve notes. They're over $3 trillion. But if we could have this special Treasury instrument, and it could become a barometer of fiscal progress toward a better picture. That is, what would investors who might normally buy conventional Treasury securities, what would they pay to have that instrument? What would they pay for that instrument? My guess is it would be an extremely cheap way for the government to borrow, certainly for that amount. I think people would oversubscribe such a thing. It would be a novelty in a sense. Maybe it would be a savings bond, only available to U.S. citizens, maybe in limited amounts, like some savings bonds offered by Treasury. Maybe it's something that grandparents buy for their grandchildren. But it also could function, even for information purposes, for the members of the Federal Reserve Board, in the same way that TIPS bonds, the yield on Treasury inflation-protected securities, are extremely informative. The yield tells the Fed what are the aggregate expectations of investors regarding future inflation, because TIPS bonds compensate investors for unexpected inflation. It compensates them based on a cost of living adjustment dictated by the Consumer Price Index. So that these investors say, I'm willing to lend to the US government, but I don't want to end up losing purchasing power because inflation turns out to be higher than the market expects. this would be the same thing, but for people, a class of investors, and I think there might be many out there who say, I want to be compensated in terms of purchasing power as represented by gold, which I see as a surrogate for commodities or for the real price level of real goods, or just as a surrogate for the real economy and what it's capable of generating. And so this would be a way for those investors to say, I would bet a loan to the government, but I like this instrument. And then that instrument becomes a way of holding up as a barometer of fiscal and monetary improvement toward more prudent policies, because I think we'll see that people prefer a gold-backed dollar in the future. And we could have interim periods of maturity if we want to measure it. But I think that what we want to see is that a preferable money unit for people? And does it send a message to government about what money could be, should be, and has been? I also think two things could happen. You could combine this with digital currencies. I'm thinking in particular, I want the US to remain the dominant reserve currency. I do not want a central bank digital currency. I think that would be a nightmare in terms of personal, economic, privacy rights. I don't want a surveillance state like China. But I would very much encourage the private sector to develop a stable coin with 100% reserve backing of this sort of instrument. And if the one offered by the US government is not enough, if 650 billion is not broad enough for market demand, why wouldn't the private sector be innovative and put together, bundled together to replicate the same structure? That is, they could take conventional treasury securities and combine them with gold futures and say, we also will provide this kind of instrument with a gold convertible privilege. Then you win them over to the side of fiscal prudence. I wouldn't be surprised if China or the European Central Bank, which holds gold on its own on behalf of its members, and the three next largest gold holders, Italy, Germany, France, they might do something like that. China might do something like that. Then you have the beginning. If a number of governments offered sovereign bonds convertible into gold into the future, if they happen to all pick the same future date, you can make adjustments if they don't. But if they happen to, you can very easily see that's the beginning of a future fixed exchange rate system. Because all of those sovereign obligations, in the end, at maturity, are equal to a specified amount of gold. So you could harness the benefits of the prior gold standard, the level international monetary playing field, but without having it dictated by government, use the power of the market to set the interest rate on such an instrument. Use the power of the market to monitor how it rates relative to other sovereign debt offerings and see if that starts moving us in the right direction. I think it would, because I think at the very least, and Greenspan talked about this, believe it or not, back in 81, he wrote an article for the Wall Street Journal talking about how useful it would be to have a gold-backed bond, a U.S. bond. And he said it would embarrass, it would shame Congress into getting their fiscal house in order. And that alone would be worth a lot.
Okay, well, a lot of great stuff there. Just with the time we had left, you did mention an issue that I had jotted down on my list of possible things to ask you about, Judy. So can you just explain the issue of fixed versus floating exchange rates? Because again, when Trump nominated you, then the Keynesians came out of the woodwork telling everybody, oh, don't listen to this right-wing. Now, one of the things that they were trying to hang around your neck was like, oh, she had written this thing in support of fixed exchange rates. And I mean, that's like price controls. I mean, doesn't she know anything? And so can you explain in the context of currencies and what it means to say you're in favor of fixed exchange rates, which again, like a priori does sound odd. Like I thought, don't you want market prices to be able to fluctuate supply and demand?
It's interesting. My research is just steeped in this classic debate between fixed and floating because of Milton Friedman at the Hoover Institution, because of my own mentor, Robert Mundell. They had a very famous, called the Nobel Duel, set of debate questions carried out in the Canada's National Post. And they had a series of debates where they wrote back and forth to each other on fixed versus floating. And I'm a big fan of Frederick Hayek. So one of the most impactful papers for me was when he wrote about private competitive currencies. I think you have four options in having a monetary system, a monetary arrangements. And I wrote about these in Money Meltdown in 94. The subtitle of that book was How to Restore Order to the Global Currency System. Well, you could have floating rates, so you have government issued currencies that are floating, the vacuum that was left after the end of Bretton Woods. And I might just say, Friedman himself said prior to that era, he said 95 out of 100 economists would have said that's the crazy approach. You have to have a fixed exchange rate system or you can't have free trade. And the U.S. championed free trade only after we disallowed currency depreciation under Bretton Woods. So you could have the fixed exchange rate system. You could have a float of the sort that Milton Friedman recommended. You could have a pegged rate system, which would be more like Bretton Woods, where one country agrees to redeem, but that's very vulnerable to that country's sense of responsibility. Or you could have private competitive currencies. I actually think private competitive currencies is the most appealing to me as a theorist.
Mm-hmm.
And at the time he wrote that, I remember Greenspan got his PhD late, but that was a very important paper to him as well. Hayek's private competitive currency paper. It's a very interesting idea. Technically, we might be much, much closer to doing that. I once made a presentation at a Cato International or Monetary Conference, their annual conference, where I said, let's go to something like that. We could consider it. And everyone on their phones checking out at Costco could quickly scan private competitive currencies. And now it could be like a MasterCard or Visa or American Express. You have a choice how you pay for things, but the means of payment could be in any one of those currencies. And at any given moment, you would take the one that gives you the best price for your purchases. And I could imagine someone coming up with an app now you could use AI to figure out, depending on what products you buy. And I said, let's call this new approach harmony, because we're going to reconcile all the possible currencies and then decide which is the best. And that's using competition to get the best product. And then that best product would fulfill all those functions of money that economists like to talk about. The problem with Milton Friedman's approach to what he calls floating rates is it starts off as a cartel, or at least an oligopoly, because the only issuers are governments. So there's automatically a barrier to entry. We didn't have the concept that people could privately offer their own currency. And so I think that's the problem. I almost would say the one thing we shouldn't let governments do, if you want to go to a private competitive currency system, is offer currencies. Certainly, if you look at the cryptocurrencies today, the fact that you have to pay capital gains on what you paid to have that money versus what it's worth now when you want to utilize it, what an advantage versus a dollar you received 20 years ago. At least you can use today and not be taxed as capital gain. So government has such an inside track that I think you would have to level the monetary playing field, and it would be safer to do that with only private issuers. I don't think we're there yet. What I decided in 94, and I would say the same today, people prefer that their money is issued by the sovereign government, or in the case of the European Central Bank, by an institution where their governments are official participants. People feel comfortable. Mandela always thought there was a link between military power and being the dominant provider of currency. It went from the UK to the United States in the interwar period, but he always thought that was important. We know China wants to be a world power. I think they, on a parallel track, want to be a premier currency provider. So those things do tend to go hand in hand. So I think we still have sovereign nations, and I think people still look to sovereign governments. But could my idea, be at least the beginning of an approach where you could consider you could have private entities combining probably treasury securities, and in particular, this sort of treasury offering. I call them treasury trust bonds, the gold convertible long-term debt instrument I'm proposing. And you could begin to have true competition because maybe now you would allow stable coins to be developed and not penalize them relative to what the U.S. might make available. The U.S. might not have its own stable coin, but you could have private sector innovative providers who build a stable coin based on claims to that payoff with the convertibility feature.
Okay, well, this is fascinating stuff, Judy. It's interesting because besides just, I'm a fellow at the Independent Institute, I academically have been interested in a lot of this stuff. We here at Infineo, who are, running this podcast, we're involved with the tokenization of real world assets, taking assets and putting them on the blockchain. So the kind of things you're talking about, that's what we're doing is in terms of our day job. So it's really interesting. And yeah, it's exciting to see how this is all going to unfold. Well, because of the clock, folks, we got to wrap it up here. My guest has been Dr. Judy Shelton, Senior Fellow at the Independent Institute. Her forthcoming book, it's available for pre-order right now, is Good as Gold, How to Unleash the Power of Sound Money. Dr. Shelton, thanks so much for writing this book and all that you've done for the cause of sound money.
Mike, great pleasure to be with you. And I appreciate very much the work you're doing. And I thank you for speaking with me today.
Thank you. Thanks, everybody, for tuning in. We'll see you next time.